righty. How's everybody? It's Friday. We are live on the Real Life Real Estate Investment Show. My name is Luis Alejandro Lopez. I'm here to teach you guys as much as I can about real estate. We love to make money in the stock market, but we need to put that money somewhere where it's kind of safe. So structures and homes are usually the safest bet. Hector Hernandez, my co-partner, my friend, my buddy, my mother, my brother from another mother, might be showing up a little bit late, but we have a really nice surprise for you today. You see the title which says passive investing in real estate. We like to make money without wearing pants. And it's amazing. It's great. We can do it. We do it usually when we're trading, but we can also do it in real estate. So today I got a good friend of mine. Oh, before disclaimer. We're two guys on the internet. We've done a lot of stuff. Those stuff that we've done has worked for us. And we flipped and sold and rented and did a whole bunch of stuff on a whole bunch of real estate. So what we work for us might not work for you. Remember, please, you're the guys signing if you buy a house. You're the guys, if you're clicking an auction, you're the guys buying the stuff. So do me a favor, just be careful. Think about it. If you have any questions about real estate, reach out to us. We are here. We can answer your questions either by YouTube, on Slack, put some comments, whatever. We are trying to teach you what we've done and what has worked for us. Okay, the presentation is intended for education and entertainment. Hector just jumped in. Let me see if I can promote them. You're there. Promote panelist. There he is. Let's see if he should come back. All right. If you guys are aware, we are going to Orlando. We're gonna have the real life trading retreat, the everything day trade retreat. I'm not sure if Tony's going, but Jeremy's going, Matt is going. I'm not sure who else, but we're gonna have a great trade. I was in the one in Vegas a couple months ago, and the experience is amazing. So please, if you want to go, you can go here on the reallifetrading.com. If you go to the events, no video allowed. Give me 1 second.
What's up, team?
Yeah, I've got the same
Can you hear me, brother? Yeah, you got to put us as co-host, Lou. You got to show the spotlight.
How do I do that?
Same way that you upgraded to panelists, just upgrade to
make co-host, got it. Make co-host, got it.
Okay, here we go.
What's
going on, family? I'm joining you guys live from Miami, Fun Launch. Big old event full of real estate and all kind of fund managers. There's people out here who are crypto fund managers, options fund managers, but about 70–80% of the room is real estate fund managers. And so I came here to learn from some of the best in the business and expand a little bit.
Nice. So how much money you raised today?
Let's just say it's been a good couple of days.
That's good. That's awesome.
Let's just say it's been a fun couple of days, not just learning, but definitely a lot of meeting some powerful people and being able to add some investors to the database for sure. It's been fun.
Cool. All right. So here, I was talking about Orlando. Jason, has you ever been in one of those retreats?
No, not one of the trading retreats. I haven't made those yet.
So
I've done been to the island, but that's that was not a trading retreat.
I'm not gonna say anything. You beat us all. You went to the island. So yes, if
you win, buddy, you win.
Yeah, you win. You won this one. The retreat, it's next week. Then 2 weeks from now, May 21st to the 24th. All the information is here, reallifetrading.com/Orlando. Okay, Jeremy's there. I believe they are still working on the resort information is here. I think they're still working on the what they're gonna be doing the agenda. But guys, it's worth going. And I was in the Atlanta retreat last year. I was in the Vegas retreat. This year, just being on the same room with everybody, it's a great experience. Okay, 26 spots remaining. Just reserve if you want to. realtrain.com/Orlando. So please make yourself a favor. Let's roll with this. Real estate for heroes. Hey, hero. You doing another one, correct? Do you have a date?
We do not have a date yet for the next one. The first one is still ongoing, and it's just been a lot of fun. So I will definitely be hosting another one. Probably by the next time we have the show, I'll have dates.
Okay. Perfect. So if you guys don't know, Hector here is doing a full-blown mentorship for heroes, meaning it's a mentorship for veterans, for active military, for anyone that is being, either retire or anything. It's free. So basically, the regular mentorship that we show you how to, flip homes, how to buy real estate, how to finance it, how to fix it, how to sell it, he's doing it for free for veterans. So please, if you want to jump in, you want to jump start, just keep an eye on us, keep looking at the show. We're going to have a new date. This one filled up in like 2 days. Okay, so please, it's for you, it's free, just as a matter of my brother, he wants to say thank you, and here you go.
By the way, the waiting list is live right now on the website. So if someone wants to get ahead of the ball and just go ahead and sign up for the waiting list,
So
there's
you
a couple
have it
people already on the waiting
heroes,
list.
right?
Yep, same link. The basically the button switch from join now to get on the waiting list.
To RCVP. Okay, perfect. I'll find it. And the last thing we have, Jason is paying us today. How about that?
Hello,
That's the
everybody.
best thing we have today,
That's
man.
the best thing we
Woo!
have today.
King
Now, let's talk a
Jason in
little
the
bit,
house.
Jason. Jason, we all seen Jason on Slack. Jason's been with RLT, what, 2-3 years now? Pretty
Yeah,
much.
it's been a while.
Pretty much. Brother went to the island. He has done every class. He is an electrical engineer. He decided to retire. He's, a stay-at-home father, trading at the same time, which I don't know how he can do it because I can't. Either I'm with a kid or I'm trading. Real life trading since pretty much forever. Okay. And he decided to, let's see what happens if I start touching a little bit of real estate. So he's been doing passive investment, obviously with, a whole bunch of kids at home. He's being the head of the house. You don't have that much time to do major real estate renovations, things like that. So Jason has been doing passive investments in real estate. So our show today is exactly how do we make money on real estate with our pants off? Okay, we don't have to be dressed up. We don't have to be doing anything. And how passive it's really passive. And Cuba as well. That's
Wait,
awesome.
did you say with our pants off, bro?
Yes,
are we doing
man.
pants off real estate?
Well,
Yes.
pink pants, they all depends. Everybody can do it.
I would stand up and show everybody, but we're going to keep it PG.
Did you get your chicken pants today? Because you're wearing those chicken pants.
I got them last week. I've been wearing them every time I trade to remind me to just click the button. Quit being a chicken.
That's awesome. So my question to you, and the whole thing that we wanted to bring in, it's how passive is passive investment. It can be as passive as you want to make it. So for you, Jason, how the whole passive investment has been, or talk to us a little bit about you first. Retired.
So, retired, stay-at-home dad. I actually kind of hit the jackpot. I retired like 2019, just before COVID happened, and my wife's a pediatrician, and so the timing really paid dividends. So she was able to focus on work and everything like that, and I was able to just stay home and stay with the kids. Thankfully, my youngest was not yet in school, so I didn't have to deal with remote schooling of a kindergartner, because I probably have a lot more gray hair than I did now. Yeah. So, and then I wanted to find different ways to still generate income, even though I was retired. And so I'd made a few good investments in the stock market beforehand, more of a long-term investment instead of a cash flow. So I wanted to diversify. So I started looking at various ways to get involved in commercial real estate and start getting some limited partnerships And then lately I've been working on trying to get a little more active. But I found that by educating myself on the active side, even if I don't continue that way, I'm going to be that much more of a better LP because I understand the process.
Perfect. And what you say LP is
Limited partner.
limited partner. What does the limited partner do?
So the limited partner is basically the risk capital. So when they find a deal, they're going to come out, they're going to show you the deal, what they're going to try to, they can show you the plan. You want to make sure they have a plan. You kind of want to know the market. And you also want to know their exit strategies. So for the last few years with low interest rates, the exit strategy has pretty much been same thing with single family, buy it, clean it up a bit, flip it. So really quick turn times. I was in one that hit all its metrics in 18 months. It was supposed to be a 5-year hold. So I was very happy with that one.
Yeah.
But now that interest rates are rising, that's not going to happen so much. So you want to make sure when they're getting their returns, is it all on the back end, or are they actually going to cash flow throughout the process? Because same thing with investing. I like dividends. So with my real estate investments, I want to see that monthly check coming.
Money coming in, yeah, the mail money. Perfect. So you're in a situation where you start looking for properties. Since you want to be passive, you look for somebody that will be the general partner, that has some kind of deal coming in, that doesn't require you to have any type of work and be completely hands off of the situation. Correct? So you're there just to basically put in the money. And before you put in your own money, you make sure that the deal makes sense. Okay? Correct? So basically, you're in the same situation. You are the person that Hector is training today to look for. Correct?
Mm-hmm. Yep.
That is correct. I'm hanging out with a bunch of other GPs, general partners, the guys on the other side of that deal, right? Jason here has been an LP on multiple deals. And basically what we're doing today on the show is we're interviewing him about what it's like to be an LP. And these guys here are all GPs. And so is she. Guys and ladies, it's not just gentlemen in this business. So it's all about meeting the right people, making the right connections. And I'm sure Jason can attest to this. It's not just about the numbers or the deal. It's about the people on the team, right?
Definitely. You really need to trust who you're working with. Because especially as an LP, the moment you give them your money, right, they have full control of it until the deal completes. There's no, I changed my mind, I want my money back. Sorry, it is locked up until the deal is done.
I like to say it's a 3 to 10 year marriage. What do you think about that, Jason? Is that accurate?
I mean, as a LP, as a GPs, yeah, it's a 3 to 10 year marriage. As an LP, it's basically locking your money in a CD
and hoping for a great return.
Unless you're married to somebody who doesn't talk to you, in which case it's the same thing. Because you don't have to do anything. You write a check, and then hopefully you get checks back.
A very well paying CD, right, with a whole lot of extra fringe benefits and tax benefits that CDs don't really provide.
That is the truth.
Okay. Yeah. So let's talk about those tax dividends and those tax benefits. What do you get? Let's say you buy a CD for 10% a year, which should happen. Okay. Or if you get a real estate property, what are the benefits for you tax-wise with that money that it's better for always start looking for real estate?
So for real estate, you get what is called depreciation on your asset. And usually currently they're able to fast forward that is being tapered out right now. Mm-hmm. And so I think it's down to like 80% now as opposed to 100% depreciation. Okay. So basically, they buy the asset for this calendar year, they're able to depreciate the asset 80% for tax benefits and kind of kick the can down the road. Mm-hmm. And so what that means for you is you basically get a write-off. Now it is capped at whatever money you put in. So if you put in $50,000, the most that you can take advantage of on the tax saving is that 50,000. But it also means basically your return it balances out. So it's
balances out. Yeah. So basically, what you're telling me is that you buy a property, okay, you fix it up, you put tenants in there, Okay, so you're adding value to the property, you start getting money out of it, and then when you put your taxes, you're telling the tax IRS and you're telling the government that the property depreciated, correct?
Yes.
And by the property depreciating, you did not make as much money because the property lost value, correct?
Correct.
On paper.
On paper.
On paper. That's totally legal. That's one of the great benefits of real estate. So even if you're making money on paper, you are not. So if you're not making money on paper, you don't pay taxes on the money that you're not making. And like Jason said, then you're gonna kick down that can down the road and down the road and down the road. At some point, you will have to recoup and will have to finalize the transaction whenever you sell or whenever you transfer the property to somebody else, or at some point, the property will have to pay taxes. But even still, there are ways to handle that. There's called 1031 exchanges, etc. So even if you sell, you still don't pay taxes on that money. So basically, it's money that is growing pretty much tax-free. It will have to be paid at some point. And that some point will be, can be 10 years, can be 15 years, can be never. If you set up your company in a sense, let's say your trust, where you have your children and your children's children and your children's children have that property, the property's never been transferred from one entity to the other. It never will have to pay those taxes. So that's one of the beautiful, beautiful things about real estate. So, Jason, what do you look for in a property? So let's say you're a limited partner. Being a limited partner, you are open to receive all kinds of offers from all kinds of people. So not only real estate, you probably can invest in whatever, from music acts to who knows, to barrels of scotch,
Bourbon.
whiskey, bourbon.
Yeah.
Okay. So what do you look for in a deal? Or what do you for in a transaction, an offering? And how do you start segregating what you like and what you don't like?
So the first thing I look for is where's the market? I like primary and secondary markets. I tend to stay away from tertiary markets. And what I mean by that is, like large cities like Dallas, Fort Worth is a primary market. Some of the suburbs would be considered secondary markets, and then out in the sticks is your tertiary markets. So they all need housing, but the primary and secondary markets I prefer because there's simply more data available. With the tertiary markets, you've almost got to do the calling to get the comps to see if they're telling you the truth, right? With the primary markets, it's Google will spit out your answer. Possibly ChatGPT now. I don't know how well they scan rents, but I'm sure they got something. So I want to see primary or secondary market. I want to see what's their play. Is it value add? Are they just getting a class A? They're going to buy and hold. What's their plan? I like to see on the back end. I want typically 12 to 15% IRR as a minimum, internal rate of return.
Okay.
And then I want around 50% of that coming in cash on cash. Because what that tells me is it's cash flowing monthly, right? So I'm getting that mailbox money, and that if you see, say it's 2% cash on cash and an 18%, that means all your money's coming at the exit. So if interest rates stay where they are or go higher, the chances of them hitting that exit number go down. Because as the cost of money goes higher up, the value of the property is going to kind of start to taper off. Same thing you see with the residential market. You're going to see it in commercial as well.
Okay. So basically, you're looking for 18% IRR and 50% cash flow. That's a hard number to find. So
it is now. It's getting harder. So.
Of course, because again, the property values went up so high that then you have to try to refi and lose 7% mortgages right now, and I'm sure for commercial, what Hector probably knows, 8 and change.
Yeah.
No, they're actually down. And Jason, you've probably seen this if you. I know you've been underwriting. I think we're around like 6.5 right now. A couple of the deals that I've seen come around my desk, right, Jason?
Yeah, if they've got a property that they've stabilized, I've seen agency, I've got some quotes right now that are down to about 5.6.
Nice.
So agency debt is where you want to be, but the property needs to be stabilized. It's a lot harder to get agency debt. They're very conservative.
Correct. And so, Jason, can you explain stabilized for us a little bit here?
So a stabilized property is considered one that is financially healthy. So that's going to impact a little bit on the returns. But if the market has rent growth and there's renovations to be done, you can still easily hit your target metrics for returns. But stabilized basically means that it's 90% occupied or more, and it has been for the past 3 months on average. So, basically they didn't just get a bunch of people off the street to rent at whatever rate to pack their occupancy. And so that's what agency debt's going to take. It's going to take 90%. So the bigger the property, the more you have wiggle room on that one, I think. But for most properties, especially me, because I want to find mismanaged properties. That's really a nice one. So if somebody's in there, maybe they've owned it for forever outright. It's cash flowing. They don't owe anything on it, so they don't really care about it. Those are gems because they haven't put much into it, and so typically they're letting their expenses grow. They're not really paying attention. They're not pushing their rents up to market. And so there's a lot of value to be created there by coming in and properly managing the property, bringing the classic units, renovating them, and then bringing rents up to market.
So that's what is called a value add play. So you come in, it's poorly managed. The people I'm not saying they don't know what they're doing, but the rents, they know that what should be in the same market. You come in, you renovate, you paint outside, you do all kinds of things, then you start renovating unit by unit. And as soon as each unit gets renovated, it gets rented at the new rent goal. Automatically, your income starts coming up. It's basically the same thing if you buy a single home from somebody that has, it's a tired landlord. Remember the one we did, the 40K in 40 days? You just didn't want to do it, but you do it in a bigger scale. And you have somebody, which is the general partner, that Hector is to show you right now, which are the ones doing the work. You just need to make sure that the person that is doing the work, it's really doing the work. So
it's capable of doing the work. And so just like we share with the audience many times on the single family side, there's ways of adding value on the physical asset in terms of improving the asset, like Jason was saying, painting it, or like Jason was saying, something more along the lines of mismanaged properties, either because the landlords owned it for a long time, have let those costs creep up, have not kept up with market rents. And we're seeing a lot of that right now on the market. In fact, most of the deals that are coming across my desk are assumption deals, people who have decent loans. So the loans are, somewhere in the 4s or even below, but they failed to keep up with rents. They did a nice job refinancing at the right time, but rents just exploded over the last 12 to 24 months. And so where the value add comes in is just bringing that rent to current market. You don't necessarily always have to do a ton of major rehab or a heavy lift rehab, which is when you're basically gutting the entire unit and bringing it up to today's modern standards, which can be a little bit riskier, but that oftentimes does have a higher payout. But there's always a different way of adding values, not just construction, like we tell you guys. And Jason, so when we're looking at for value add projects, can you share with the team what that typically looks like? What kind of debt are we using, and what those rates are looking like right now, if you happen to have been looking at any of those?
So the recent things that I've seen on a bridge loan, and basically a bridge loan is something you get on a property that doesn't qualify for agency, and they're basically bridging you to a point where you can refinance. And typically it's riskier, so you're going to pay a premium. I have seen them down to 7.5% lately, and so that's not bad. They were pushing like 9% for a while there. It was getting pretty scary. And the one thing that kind of makes those a little bit more palatable is they'll typically, for the full term of the loan, it's going to be much shorter. Usually it's a 2 + 2, so 2 years, and you can tack on another 2, so 4 years total. It's all going to be interest only. So you're not going to work your premium down, but it's going to help your cash flow side because you're not having to pay the premium. You're just having to pay the interest on the mortgage. So the quicker you can get it stabilized and get your 90 for 90, get your NOI bumped, you probably want, I'd say 12 months minimum of your good NOI getting closer. And that NOI is net operating income. That's the money that's left over after you've paid all your bills. And that's how multifamilies is valued, how much cash is left over for us at the end of the day.
That's the actual final profit, technically speaking.
Yep. And so then, you know, you can refinance and hopefully get agency debt and have a little capital event where you're able to return some of your investors' money. Sometimes I've seen people pull off almost 100% return at their refi. That's crazy. It's not going to happen all the time, but it's a nice thing.
That definitely happened.
That used to happen a lot.
2021, right? And just so what Jason is referring to when he's talking about agency debt, we're talking about the big two, Fannie and Freddie. Fannie Mae and Freddie Mac is essentially just like in single family, they provide that agency style of debt. There's HUD too in multifamily, but for the most part, most people are looking at Fannie and Freddie products, and they are the authority and they set those lower rate standards, but they also set the rules. The occupancy rate needs to be, what the debt coverage ratio needs to be, what the loan to value is that they're willing to give you. And so, a lot of people have been seeing that those numbers are coming down right now, and it's mostly just due to a nature of them being more conservative and needing to require that debt coverage ratio to be strong for you to be able to cover the debt. And debt coverage ratio is how many times your income covers the rent. So most of the time, they're going to want a 1.25. So 125% of your mortgage payment needs to be coming in rent. So just to make it easy, if you're paying $1,000 in mortgage, you need to be making $1,250. Sometimes when they get a little sticky, when the deal in some markets, they'll go up to 1.3 if it's not a major market. In the major metropolitan markets, you should be able to get a 1.25. Is that what you're seeing, Jason?
Yes.
Perfect. So let's say you got a lot of deals coming in. Let's say the numbers start making sense. What else do you look for in a transaction, in a deal? Something that gives you, warm, fuzzy feelings where you want to put money in. One of the things we spoke about was the GPs. What do you look for in a GP?
Usually I just look for their track record. Have they done it before successfully? And so that's kind of the end all be all. What was their last transaction like? How many of things have they delivered on this style of product before in this style of market? And so that's how you kind of get the warm and fuzzy. And then, just talking to them, are they a used car salesman pushing you to sign the dotted line today? Or are they like, hey, here are the actual risks, because you do have risk. I know people who have lost their entire investment, which is interesting because I find in commercial real estate, you got to really try to lose money. It's hard, but some people have pulled it off. Usually the worst case I see is you just don't turn a profit. You still get most of your premium back, or maybe a small bump. So you lose the time value of money. But yeah, so mostly just track record, and are they explaining the pitfalls? What's their game plan? What could go wrong? How do they plan to mitigate that if something goes wrong? And I like to see them base the returns kind of on the medium line. Rosie's up here, which would be great. We'd love to hit it, but here's what we're saying is going to be our real target. And then give me a worst case. Let's say everything goes against us. What happens?
Okay, so everything goes against us. Those, how often have you seen those? Are they something that you see in common? You mentioned that you've seen people lose all their money. Why is the reason why they lost their money? Mismanagement for the most part, correct?
That one was, I don't think they understood the market they were going into. They expected that MSA to kind of be the next big thing, and it wasn't. And so they were trying to get in front of the path of progress, and the path of progress didn't go to them. It went elsewhere. And so that was kind of just, you tried, you failed. And so that's really what I like to say. I want to say in the primary and secondary markets, I don't want to be the first one on the block. I want the McDonald's to show up first, McDonald's to prove the market, and then I'll bring my Chick-fil-A, or Burger King, or whatever you want to call it. That's where the most risk is out front. It's got a lot of reward, but I'll take a slightly smaller reward for much less risk.
For a much healthier chicken sandwich, right?
Yeah.
Yeah, I got a good friend of mine.
I love how you compared those two, man. That was good. That was a good
perfect
comparison.
Actually, I got a good friend of mine. He runs a chain of Mexican restaurants. He's the same thing. If there's a Chick-fil-A, I put a restaurant there. They rated all the research, all this stuff. So he goes and looks, 2 blocks away from Chick-fil-A. That's it. It's perfect. Or Starbucks.
Yeah, you don't want to be the first guy there. You don't want to be the last one either, but somewhere in the middle is just about perfect.
Mm-hmm.
All right. Now I got another question for you. Let's say you're LP, you have some money to invest in real estate passively. How much money do you need? How much money do you start? Do they usually look for what in an investor? So walk us a little bit, in that sense. How do you get deals? How do you contact those people?
So
Hi, Jason.
For the most part, I got into it just through my network. And so somebody was like, hey, this is what I do. I knew him. I trusted him. And then I was like, where's it going to be? He said, Alpharetta, Georgia. I had done work in Alpharetta. I knew everything about the market. I just said, here's my money. And it worked out great. So the amount of money you need is going to vary by the overall size of the project. Because the more LPs you have, the more paperwork, the more legal fees are going to cost just to get all the paperwork in order. And so the larger projects, they're typically going to want $50,000, up to $100,000 at times. But smaller projects you can get into for, I think, as low as $10,000. I've seen in some instances.
Just not bad. Just not bad at all.
And then it's important to understand, I don't want to get too heavy into it because it's a pain in the butt. There's syndicated deals, which are very easy to find. You can Google it and everybody and their brother will offer it to you, but you have to be a high net worth individual, right? The better path would be to talk to people doing smaller deals, talk to them, let them get touches, because that means that you can qualify for basically an educated investor. You don't have enough money for the IRS to say, yeah, they can go ahead and give you money, but you've been educated, and so you're aware of the risks, and that qualifies you to invest. 506B, I think, is the classification.
Yeah.
And so that would be with smaller money, just getting started. I'd say find people that are doing 506B deals, stay in touch with them, develop a rapport, because that will enable them to include you in their fundraisers whenever they have them.
Exactly.
Or you can
so
put
what
money
Jason
with
is referring to, go ahead.
Or you can put money with you in your fund, right?
Yes, indeed you can. But what Jason is referring to is SEC Rule 506B and 506C. So 506C is going to be strictly restricted to accredited investors, which are individuals who make over $200,000 a year or couples over $300,000 a year, or those with a net worth of $1 million or higher, not including your primary residence. That does not count towards the net worth. 506B allows the general partners to include all investors regardless of income and regardless of net worth, as long as they are sophisticated or intelligent enough to understand what it is that you're offering them, and you have a relationship with them. And that's what Jason is alluding to, that you have to make sure you stay in touch with these GPs and that you build a relationship, not just for the sake of obviously getting to know them and understanding if this is the kind of individual that you want to place your money with, making sure that, their vision of life and their vision of investing aligns with yours, but more importantly, for SEC rules. And in order for them to stay compliant, they have to know you, and they have to know that you are sophisticated enough to understand this type of investment and be able to execute without needing with knowing what your risk is, right? And you can sometimes, if you don't have all the sophistication or all the knowledge, bring in an investment advisor to sign on the subscription for you and to say, hey, I explained this to this person. But most of the time, it's going to be a lot easier if you just have that relationship and you just get to a level of understanding where you yourself can understand the investment. It's going to make it a lot safer for you.
Yeah, and a good GP that's doing raising, they're going to be explaining the risk to you. They're going to be educating you because they want you to know what's going on. They want you to be aware of the risk and the returns and all the possibilities, because it's going to make their life easier down the line.
Bingo. And you know what? You just brought up a good point. I'm thinking of putting together a how to become a sophisticated investor course. If you guys throw a couple ones in the chat, or if you're watching on YouTube later, if you leave some comments on this video, if I get enough traction, I will definitely make the class and include some of the examples that Jason is talking about, and basically help you all get to a level where you're able to understand these types of investments and become sophisticated by market standards. Awesome. Love it.
Perfect. All right. So let's have a look at something. You sent me earlier a couple of offerings. So basically what you get, I'm sure you get in your inbox a whole bunch of they come as emails, they come as packages, everybody tries to put your piece of paper and in front of you. How does that work? You get things like this. Is something that you will get, or you will get them at the you start looking for them. How do you usually do?
Usually I start looking for them. I've got a few relationships that I've developed with brokers that are going to get me these a lot quicker before they go public.
Okay.
But for the most part, just Crexy, LoopNet, Google.
Perfect. Bucket listings, LoopNet, Google. So you get, this is the offering, basically.
Mm-hmm.
It's a big document which has all the information about basically the property that you want to go. You want to walk us through a little bit through this?
Sure. So I usually skip the first page, second page, third page. They bury the good stuff. So here, the summary. Sorry, go up one more.
Summary here? No.
Nope. Up.
Okay.
Up.
Up.
A little bit more. So right here. So here I can see that it's in Columbia, South Carolina. Primary market, which is good. You see right there where it says 98% pre-leased.
Yes, sir.
That's all fine and dandy that it's pre-leased, but I want actual leases. Pre-leased means they've got units that are under lease, but nobody's moved in yet and put money on the line. So pre-leased is fine and dandy, but we want people who are actually moved in and paying rent.
Could it be that it's new construction? No, because it's built in 1973.
Built in 73. Yeah.
So they were probably remodeling, and they're waiting until the units are ready to have people in.
Mm-hmm. And then that's the other thing. I like Class B or maybe C+ properties. C- is usually going to be a heavier lift, and it's an older property.
Mm-hmm.
So that's fine as long as the investment team knows how to do their due diligence. Last thing you want is foundation issues, or the big thing is usually plumbing when you go into these older units. Or in Texas, some of them have chillers that cool the entire complex.
The entire building.
Yeah, and so if the chiller goes out, all of your tenants just lost cooling, which is not fun in Texas. So I tend to try to avoid those, even though a properly maintained chiller, being an engineer, will run like a top, but properly maintained is kind of the key.
Okay, so we have 100 units built in 1973, 98% pre-lease, but we don't really know how much is the average rent. It's $1,000. Okay. And the rent per square footage is 83 cents, which seems kind of low for being in good shape, but I'm not going to say a word. You're the expert. So what else do we look for here?
Now we keep on keeping on. Scroll down, and then so here, if you don't know the market, this is where they're explaining the market to you. You know, why do they think this is a good market? And so they'll highlight large employers that are there, museums and attractions and such, and why are people wanting to live
In that neighborhood.
in that neighborhood?
It's the state capital, so they keep giving you information about jobs. Volkswagen Group or Blue Cross Blue Shield, Chick-fil-A has some jobs. Everybody's putting money into Colombia. Okay, so they're gonna be telling you a whole bunch of things, which when Jason said, they can be verified by Google. Or a little bit of research, which it probably cannot be done by something in the boomsticks in the middle of nowhere. Okay.
And just to clarify something real quick here, team, Jason switched from his LP hat right now to his GP hat. So he's actually looking at this is the actual offer memorandum for a deal, not for a passive investment. Correct, Jason?
Correct.
Just want to make sure we clarify that real quick. That this is if he was looking to be the GP, buy this property, and then put together a team of LPs and investors, this is the document that he's one of the few documents that he looks through to kind of understand the lay of the land, if you would.
Correct. But in this case, also, if you want to be an LP, this is the kind of document that you need to understand in order to be comfortable with putting money in, correct?
Correct. And all of this information, the GP team will have it. So if you
exactly
want to know, they should be willing to give it to you to let you peruse.
Okay. So let's say somebody brought you this offering, they will prepare a document similar to this one, which is what you found by somebody else that was trying to sell it.
Yes.
Okay.
Yeah, a lot of times the GP will use this one right here to add to their offer memorandum, and they use some of this information here. And like Jason said, if you want the real thing, they should be willing to share it with you because they have the property on the contract. They have nothing to lose.
Exactly.
Yep.
And really it gives you all the details, and it helps you as the investor understand the market, because that's what these things really do. It doesn't just showcase the property, but showcases and highlights every positive thing that's happening around that property in the market.
All right. Impressive property trends. Here's where we're trying to tell you. These are all the units. Here are the square feet of the units, the amount of bedrooms and bathrooms, the market rent, how the prices that they're rented right now. So if they have any losses, they have a couple of units that are slightly below market, but it's pretty much a big nothing. And they're telling you they've done a whole bunch of repairs, what is called CapEx, capital expenses. They've done a whole bunch of repairs, 1.2 million since 2020. And this is the information of the thing they've done so far. So they're trying to sell the unit with new power, new HVACs, new roof, building improvements, new windows, new painting, and renovations interior of the units. Okay.
So, and what's nice to see on the recent leases, what they're trying to do there is show you that they've proved their rents, right? So they've renovated some of the units, and they're showing you, see, we were able to push this up to market rent with our renovations.
Perfect.
So there will be usually a percentage of units not renovated, and then you can come in and continue the value add, and that's where the buyer would get their return.
Yeah, that's where you get a value add. This probably was a value add for somebody that already finished it and tried to unload on somebody else. Correct? But on the other hand, if it's properly managed, it could be a perfect property just to put your money in and just leave it for 5, 6, 7, 8, 10 years. And yep, proven value and opportunity. Here. Overhauling unit interior campaigns. All right, yeah, you're right. 17 units is still yet to receive renovations.
See, so there's a lot of meat on the bone on this one.
Mhm.
Unfortunately, the seller wanted too much of a cut of that meat, so they have taken it off market and discontinued their value add at this point because they didn't get any offering near what they wanted.
How often do you see that happening, Jason, where sellers are still above what the market is willing to pay them, and so they're actually having to pull properties down off the market? And obviously, I don't mean in the past. I mean like now in the last, couple months or so, 3 months.
Yeah, this would be the second one I've seen that came off the market. I'm sure we're going to have a few more, but it is what it is. So, and here they're just going over more pictures of the inside, all fine and dandy. And then towards the end, the broker is going to show you their pro forma. And that's where my engineer gets happy because it's all spreadsheets and number crunching. See, here they're showing comps there, who's around it, what size units they are, what age, what's their occupancy, square footage, their rents, their average rents, and what's their rent per square foot. And so what you want to see there is that, again, you don't want to be the current front runner. You can see ours, effective rents about 75 cents a square foot. And everybody else is pretty much above that. So that tells you have some room to move upward.
And they're also relative about the same age, 1974 here, that one for 13. So yeah, you have 25% increase properly if you do it properly.
Definitely some room for growth there. That's
Mhm.
nice.
Yeah, here's this one here, Tanglewood. So they go over each one of those.
Yeah, this is just more detail of each one.
And all this information is easy verifiable.
Yeah, usually you can go online. That's another reason why I prefer the primary and secondary markets, is those places will usually have websites where you can just click and take a look at what's available, and they'll give you a rent range. Tertiary markets, you got to call. As an LP, I mean, if you want to do that, you can, but typically, if you don't trust the GPs enough to have done their due diligence, just move on.
Yeah, if you can't trust the GP, if you should not be investing with them. But it's absolutely verifiable. Also, you could do as a GP, we're usually checking various rental websites, apartments.com, Rentometer. We're checking with Craigslist. We're checking with not LoopNet, CoStar, and just verifying this information, which most of the time is relatively accurate. Most of these reports are made through CoStar by the brokers listing it. It's usually the property information that you have to scrutinize, not so much the comps, because they know the comps are public record and they're easy to find. The property information and the pro forma is the one that you got to kind of take with a grain of salt, right, Jason?
Yep. And so,
right, so here we are. This is a spreadsheet to give it from one month further.
And so what you have here is you have the T12. That's the trailing 12 months profit and loss. So that's how the property has been operated, has been run. And then what you often see in properties where they're kind of mid-turn or they haven't quite got the full 12 months behind them of having solid occupancy, solid tenants, they'll go ahead and give you a T3. And so the T3, they'll annualize that. So this is what, if we had another 9 months to run like this is where we'd be. And then the end is the broker's pro forma of what their projections are. And what I like to look for here, so typically you just want to do ratios. You want to say, what's my operating income versus my expenses? Typically, that is going to be on average about 50 to 55%. So you're going to spend on expenses about 55% of what you bring in. If you start getting much lower than that, you got to kind of scratch your head like, okay, how are we running this
Okay.
property? How are we maintaining the property? Or are we actually taking care of this investment? And so that's usually what I look for here. You know, are they trying to get fast and loose? Sometimes they try to paint a rosy picture on your real estate tax projections. And depending on what state you are, you know, the same thing that you're going to get in your residential, you're going to get on your commercial minus exemptions. So you're just going to pay more. So I'll watch for that. And then coastal areas, insurance is becoming huge right now. That expense is just, it's getting bad. And so I had a deal that, I mean, it got murdered because it's in Tampa. And so Pinellas County, and it's like, and here's your insurance quote. It's like, and I'm not buying this property.
Yeah.
What was your insurance coming in at per door, Jason? Because that's definitely been a deal killer here in Florida.
3,000.
Yep. Yeah, that's about right. 3,000 a door, and this is probably a large property, right?
Yep.
So do the math, team. It gets pretty pricey. We recently did one in Miami Beach. Came in at 3,700 a door. So, yeah, and underwriting another one a couple weeks ago, brand new construction. Agents still told me you gotta be at least 2,600 a door, and this is brand spanking new with all the new building codes, brand new roof, impact windows, and still was over 2,600 a door for insurance. It's kind of quite a bit, and so that's one thing that I've noticed a lot of the brokers are not keeping up with. A lot of them, it's not that they are trying to get sneaky about it. It's just it's gone up so much over the last year that the seller is paying maybe $1,500 a door, but the new rate is going to be $2,500 a door. So that's something to really, really watch out for. And so, Jason, are you typically, do you have an agent or a broker, insurance broker that you deal with, that you go and quote this out? Or do you more or less have an idea of where it's at by area?
So by area, in my initial pass, I'll kind of, give it the old college try and get close enough. And then if I get to the point where maybe I'm called back for a best and final, or even under contract with it, I'm definitely getting a guy involved. And I do have there's a guy that does commercial insurance at my boxing gym. And so that's who I use. So if he gives me a rate I don't like, I can hit him. That was a joke. Nobody laughed. Oh.
Sorry, I was sending a message there in the chat. So one of the brokers that I deal with, Clint Orr, he is out of Texas, and he created this ratemap.org. And it's relatively accurate. And what he does is he has the average rate like by region and by state on that map. And so he does update it as frequently as humanly possible, but take that with a grain of salt. It might be outdated by a few weeks, a few months or something. But I know that he recently updated because we were talking about this Florida deal, and he brought the numbers up after he talked to me. He's like, I got to fix my map. But it's a good resource to have if you guys are out there looking. Check it out.
Ratemap.org. Yeah, look at the difference. 30 in South Florida, and you just come up here a little bit. Not even a fifth. But then again, we don't get hurricanes up here.
That used to be what the East Coast thought, and then they got shellacked a couple of times, and now their rates are taking the bump.
Yep, basically the whole East Coast, and I'm surprised maybe because Texas and Oklahoma. I mean, because you get all the stuff in Galveston all the way down here.
The big thing that's been hitting us across Texas is that freeze. We had a lot of places that lost power, and then a lot of these larger complexes are sprinkled, and so they had pipes bursting.
Gotcha.
So, and it wasn't the branches for people who know how sprinklers work. It was the risers that were popping. So lots of water.
That's what is coming down.
And so that was driving a lot of those rent bumps. Insurance premium bumps.
And then you had some of the other weather events in the Midwest, the wildfires. So there's definitely been a lot of weather events over the last 12 to 24 months that have just driven insurance up across the board. Plus, everything is so much more expensive now than it was 24 months ago with inflation. And so the replacement costs on things have also bumped up.
And if you
Absolutely.
think about it, you go far enough up the chain of insurance, it's just a handful of big players ultimately that it trickles up to, between that and reinsurance. And so, they try to spread that, and they're getting hit from every which angle. So they're going to spread that increase around to pretty much everybody.
So let's go back. What else do we look in one of these? You send me a couple of spreadsheets with rent rolls and things like that. What do we look in this ones? Again, let's look for the point of you want to invest in one of these properties. Now that you're the GP, you're the LP, that somebody's proposing this to you. What should I look kind of quick if the numbers make sense for me to start digging deeper?
Yeah, typically I'm gonna look at their vacancies, their historicals versus their projections.
Okay.
Are they saying, or and their loss to lease, right? A lot of times they'll go, oh, we have a high loss to lease, and then they're going to say they're going to close that, within the first 6 months of ownership, and that is highly unlikely, because the only way to close a loss to lease is to update your lease, and so you really got to wait for leases to re-up before you can start pushing rents to market.
Okay.
And
Where do we see
a
those?
lot-
Can you explain loss of lease? Sorry, Jason.
So loss to lease is say, if market rate from the surrounding area is $1,200 a unit, and I'm getting $1,000 a unit, then I've got $200 of loss there. It's not actual loss, but it's basically versus your gross potential.
It's lack of income, lack of.
Yeah.
So it could also be looked at as an opportunity, right? That's why a lot of times the brokers will point that out, and then they'll tell you, hey, well, this is your opportunity. This is your value add. This is where you could close this loss of lease up and increase the revenue for the building.
Yeah. And then you want to watch out. Do they have any bad debt? Have they had trouble collecting? And so that could be, if your GP team's solid, that could be another point where they're going to add value. They're going to come in and they're going to get rid of their bad actors and get in paying tenants. You look at the delinquency across a big enough unit, it's really not that bad. One of the things that gives me heartburn, but I know a lot of people that don't care, I don't like seeing late fees. I don't like seeing high fee income. That tells me people aren't paying on time. You're having to chase people down. So there's a story there that I want to figure out, like why, are you literally going door to door picking up checks? Everything should be digital these days. So here you can see they're not really having any problems. They got a lot of month-to-monthers. And so that could actually be a benefit, right? That if they have a lot of month-to-month people, that could give you the advantage to come in and quickly close that loss to lease because everybody's month-to-month, right? You find out, you either say, hey, we're really going to get you on a lease, bump your rents up, or, what have you. Or if you want to start just turning units really fast, depending on your renovation plan.
Actually, if you can see here, they started with month-to-month leases, and then they started looking in towards the end of the year because they have a whole bunch. You see, talking about July, September, October last year, they started, getting a whole bunch of them in month-to-month. So I guess they were getting ready to not renew leases, move to more renovating. Is this projection? That's the T12. This is projection, or this is actual? That you know.
This is actual.
It's actual. Okay.
So Jason, when you're looking at a deal, can we run through the top 2 or 3 documents that you're going to want to look at? Obviously, we looked at the OM already and the T12.
The T12. The next one that I want is the rental.
And so you define the T12, right? The trailing 12 or the trailing 3. And go ahead and define the rent roll for us. It's pretty self-explanatory, but if you would, just give us a little bit of a brief.
So the rent roll is just a listing of all their units and their tenants. And it should have when they started a lease, when their lease ends, what's their rent, what's the market rent, and then usually they'll have a delinquent line, although some brokers delete that column because they don't want you to see it. And you can see now when I talked about, they said they were 98% pre-leased. So right here at the bottom, you see all these renovated units that they claim they have pre-leased, but nobody's yet moved in. So yeah, now granted, you subtract those out, you're still 90% plus occupied. So for this particular property, it wouldn't be too much of a heartburn because you'd still be able to get solid financing.
Gotcha.
But under 90%, your financing gets more expensive.
And this pre-lease, we don't know when or if, basically, that was the situation, correct?
Yes, correct.
All right, so we have those things. We have the offering, we have the T12 and the rental. And the rental needs to match at the end, the numbers, the totals need to match to with whatever it's here, correct? In the basic income.
Yep.
Correct?
Yes.
Potential for rent. Let me see, where is my rental revenue here? Effective rent, utility rent. Perfect. I see it. Okay, this is gross potential rent, meaning that everything, if everybody pay on time, this is the maximum money you will get, minus every time you need to pay for a realtor, need to pay a commission, somebody doesn't pay, etc. This is the actual income that you're getting for the month. Okay. If you need to then you start doing, if you need to make a concessions, if you need to make vacancies, these are all the units that are empty right now. Okay, it comes that your actual money coming in is this one. Plus, then you start reducing all your expenses. Okay. Do you insurance income? Why do they have insurance income? That's strange.
So I've noticed some properties, depending on where they are, they require renters insurance.
Mm-hmm.
And so they provide that.
That's okay.
Yeah, so those are additional ways that the management team or the ownership can generate revenue. They will go and they'll purchase the renter's insurance in bulk and then resell it. We see that sometimes also with things like cable, trash removal. We call it valet trash. We'll come pick up the trash right from your door. You pay an extra $10 a month, that sort of thing. And it sounds like it's a small amount, but when you add it up times 100 or a couple hundred units, it makes a major difference in income.
Yep, I'm seeing it right now.
You could purchase, internet has become pretty popular. You purchase a bulk internet package from a local provider, and you go ahead and offer it to your residents at $50, whatever the case may be, a month. Just throw a number out there. But it's really costing you $25 or $30. So you're making that spread. And again, every dollar to the bottom line increases the property value.
Mm-hmm.
Because commercial real estate and is valued, like Jason said, solely on the income.
Yeah.
It's not like a single family home where we're looking at comps. We're looking at comps mostly from a cap rate standpoint in commercial real estate, but it is all driven on that cap rate times the income.
All right. So what else, Jason? This one didn't pan out because numbers were not there.
Yeah. So the thing with this one, the owner had it at a good price, at a good interest rate. So he bought at the opportune time, and he was just trying to kind of do a quick flip. And this is one of those instances where the interest rates kind of went against him. Right now that the cost of capital is higher, his cap rate got squeezed, and so he's actually, from what I was told, nobody offered even what he's got into the property at this point. So on the bright side, it's like a thing to keep in mind as an LP, right? He's still cash flowing.
Yeah.
Okay. Right. He is still making money. And he's probably at the point now to where one of the things you can look at doing at some point, he's probably got enough in monthly reserves to use that cash to renovate the next unit that comes open, as opposed to dipping into his CapEx stash, which would make it a return to his LPs that much easier on him for a capital event. So that's kind of the nice thing. Like, hey, the market's not going to give you your price just yet. Okay, I'll just
Hold
keep
it.
holding, keep cash flowing. You know,
It's I heard a saying, what is it? It's equity comes and goes, but cash flow keeps on flowing.
Yeah.
So in this case, his equity came down a little bit because of the market, but he's cash flowing. And like you said, as long as he doesn't have to touch in that CapEx budget, that return is that much nicer, that cash on cash to the investors. He can afford to, to kind of cycle that capital that's coming in through. And eventually when he's done rehabbing and we get through the interest rate hurdle, then he'll have a nice, fully up to date, stabilized property.
Yep.
Which will be cash flowing way more than what it is now. And then once you have your interest rates start to come down, then your numbers are going to make way sexier. Now he can ask for whatever money he wants. You just need to be patient and be able to hold it. Now,
you just have to be well capitalized to be able to get through the hump, which is what some teams over the last few months I've heard are unfortunately going through capital calls and things like that because they did not foresee what was coming. Most people didn't. I don't think the Fed knew how high they were going to go, really. So it's definitely been a challenging time for a lot of operators that did not properly capitalize their deals at the beginning.
Yep. They were planning to be out, and then before their fixed rate period expired, and then they didn't, and so now they're in a higher interest rate environment, and they're about to go from fixed to float, and that's going to crunch them. Now, on the flip side, I don't see why, if they're that far along, in my mind, they should already be stabilized and able to get a Fannie Freddie, which probably still more than the 3.5%, but if you're not cash flowing enough to cover, 5 and 6.5,
then again, if you're not
that could get a little scary, yeah.
Yeah, you bought too high. That's it. Or because we're not there, you either bought too expensive, or your market does not allow you for keeping increasing the rents. It is what it is. So that we're not all the way there in their numbers.
And I'd be willing to bet if you went and looked at it, their entire equity was based on return was on exit, and so they were probably pretty low on the cash flow already. So if they were signing a solid cash on cash, they'd probably be able to ride it, and just everybody cash on cash, it goes from maybe 6% to 3.5%, 4%, but they're not having a capital call and they still have their debt coverage and things like that. But if their exit was entirely on, if their profit was entirely on the exit, then they were probably running pretty lean with maybe a 1 or 2% cash on cash. And the moment the expenses shot up, the cash flow evaporated.
So that brings me to another question now that you mentioned that. When you get presented all these deals, you can are the ones that we're looking to recoup everything within 7 years, whenever. So when you say that they run really lean on the expenses, mean they're for properties that you're looking to capture the value when you sell, correct? So most of your income or all your profit of that money is going to be when the property sells. Now, there are other ones where you capture your property or you capture most of your income when you're doing your cash flow, correct? Which is that mail check. How do you see the difference, or how do you spot the difference in one offering versus the other, so you can know what are you looking for? They will tell you that they're looking to cash out in whatever amount of time, or how does that work?
Yep, that should be part of the investor presentation you get. What is their exit strategy? Like the one that I did, they basically said they're expecting a 7% annualized for it had 2 classes investor. I was class B, so I had an equity stake. So they wanted a total of 15% IRR, with half of that coming from the sale. So they'll tell you pretty much how much, or they should give you like a summary where it's going to list out how much of your return is coming in that mailbox check and how much is going to come at the
very end.
Yep.
So if you see a heavy weight at the end, that's when hey, I got to watch out. Because now it's more of a speculative play. Am I right, Jason? And so if the market goes with you, great, home run. If it doesn't, it could get a little hairy and sometimes scary.
Yeah. So you want to make sure in that kind of instance, I'd probably dig a lot deeper into what their reserves are going to be. How much extra cash are they raising to address any unforeseens?
What's extra cash, unforeseen, Jason? The market's gonna be on our side, man.
Real estate only goes up. What's your problem?
Yeah, the trend is your friend until the bend in the end. It works for real estate too.
And it is bending.
Yeah,
it has bent.
So, but a lot of people I've talked to on that front, I don't foresee another raise anytime soon. I think they're going to pause, and then I think in 12 to 24 months we might actually see a first dip. So
that's about what I've heard as well.
Yeah, that's
from some of the gurus, some of the experts. I think we'll probably maybe one more, and maybe we plateau for 12 to 24 months and see what happens then.
Yeah, but the good thing for our side is since they've actually at least slowed the pace to become more predictable, that spread that the lenders were all building in has come down. They were getting crazy.
It's come down tremendously. Yes. I actually was talking to a buddy who does commercial lending, and just a couple months ago, it was a 210 basis points above the 10-year. Now they're down to like 150, 160, somewhere around there, which is a little bit more reasonable.
Yeah.
And that's essentially the 10-year is what a lot of these mortgages are priced on, and the lender is going to put their spread above what the 10-year treasury is trading at. So if the 10-year is trading at 3.5, and they're going to want a 2-point spread, that's going to put you at a 5.5, and so on and so forth. So as that 10-year, and the 10-year also, I haven't looked at it over the last week or two because I've been kind of busy here, but it's come down a little bit, right, Jason?
I believe so. I don't really.
Last I looked at it, it was coming down a couple of weeks ago, but it just goes up and down depending on the day and what's going on. So, and then that's another thing that an operator that really understands that can kind of, to a certain extent, lock that rate in when it's a favorable time and not when the lender tells you to, because I've seen some operators just lock for the sake of locking, and then a couple of weeks later the 10-year actually dips, and they could have saved themselves quarter of a point, a tenth of a point, which when you're talking tens of millions of dollars, it makes a difference.
Yeah, that's a chunk of change at that point.
All right, so let's see if we can close up a little bit. Jason, now that you've done it, now that you're used to running numbers, how passive does it really is investing in real estate?
For the
How passive can you get it to be?
If you find the team you love, it could be extremely passive, right? I know the one that I just did. The deal came to close, and they had a 1031, and I want to say 85-90% plus of their investments 1031 over with them. So I would say that's a pretty resounding shot of like, hey, I trust you. Keep, like blackjack, double down, double or nothing. Let's go.
So basically, you don't work on it. You just trust the team, give them the money, go away, give me a loan, and send me a check.
Yep.
Nice.
So, but it's that trust and knowing the team. Do they have a track record? And again, I still check to see what market they're in. So, and if I didn't know the market, then I'd probably do a little more research or give them a call and be like, what do you see here that I'm not seeing? There's not even a Chick-fil-A.
Where am I going to get my chicken sandwich when I come visit the property?
Right?
Actually, that brings up a next question, Jason. When you LP, do you ever have to go to the property?
No.
Ever?
Do you ever have to take a tenant phone call?
No.
Do you ever have to worry about if the insurance or the tax bills are paid?
No.
That is passive investing at its finest. You bet the team, You look over the deal, you make sure the deal is good. And then, like Jason said, when they're rolling to the next deal, you're just basically going to skim over it to make sure it still matches your criteria and somebody on the team didn't go crazy. And now all of a sudden they're going to go, invest in a whole another asset class or whatnot. And you just let that capital roll over to the next deal with that team that you've already established a relationship with and keep collecting. And I'm not going to say mailbox money because that's not a thing anymore, guys. You're going to continue to get those wire
ACH money.
transfers, that digital coin, okay? Digital money.
All right, so let's close it up. What's next for Jason, man? What are you looking for now? Because you're killing it here. You're killing it trading. So what now?
I just want to keep building the multifamily. I want to keep building that passive stream of income, and then I'm going to use a lot of that to fund pretty much a family fund, and then I'll allow me to give to charities I like in perpetuity. At the same time, my daughter, the product of a doctor and an engineer, and she wants to be an artist, so I'm going to make sure she's not a starving artist. So things like that. Just take care of the fam, enjoy vacations, not have to worry about money. It's a beautiful thing.
That is a blessed life right there, my friend.
Yes, sir.
Thank you so much for coming on and sharing your story and sharing your skills, Jason. It's been amazing to hear your story and to learn from you. I definitely look forward to you getting your hands on something, and we can call GP, or I can LP with you, man. Let me know when you grab a good deal.
Something shows up.
Yeah, I've got a couple of them that we're chasing over in the Carolinas that are looking pretty nice. So we think we got a real shot at some of those. So yeah, that phone might be ringing sooner rather than later.
Let's do it, buddy. I'm excited, man. Can't wait.
Yeah, for sure.
Well, thank you so much, my friend. Much appreciated. And with this, I guess we are going to close it. Do we have any questions? Let's get one in the chat, two in the chat. Do you guys like the presentation with Jason? Do you guys learn something about passive real estate today? We can do it. Everybody can do it. You don't really need to be, just be careful with the numbers. Jason, if you want to learn how to be in passive real estate, where do you start? Besides taking
yeah, I would probably say look up in your local area any kind of real estate investment meetups. Granted, you're gonna meet all kinds of people there, so just know that. But that's kind of the best way to get plugged in. Find out even if you got a realtor, call him up. Say, hey, who do you know in the multifamily space? I'd love to meet them, because capital raisers are always looking for people who want to give them money. So it'd be, you got money, then people will be happy to talk to you and try to find help, bring you opportunities to invest that capital.
Absolutely, like my brother's pointing over there. You need to talk so you'll be on camera, because remember,
it's it's about networking. It's about being in the room. I think Jeremy has mentioned this all the time. Buy a ticket into the room. Cost me, we bought a bunch of tickets, so it was like maybe $150 to get to this conference. I've been here for 3 days. I've met epic amounts of really good operators, some okay ones, but a lot of really good ones. And it's just a matter of being out there and networking and seeing who you jive with and who you like their strategy.
And if you like this one, guys, you have any questions, you got any comments, please text us, email us, realestate@reallifetraining.com. If not, you can put some comments in the chat below. If you want more information about us, reallifetraining.com/RE. This is where we are. That's where we live. Let me see it. I put it over here. This real estate. That's where we are. You see that handsome face right there? Look at that mug. All right, Hector is here. Luis is here. We can teach you how to flip homes, how to invest in real estate, how to do pretty much all those things that we've done. We still don't have a date for my Burr presentation. It's supposed to be really, really, really soon. Again, if you missed one of our shows, if you missed anything, They are always living in YouTube, so we will be there. All right, make room for it. We have a great books. Please go through this. This will change your mind. It will change your life. Pick a few, read them, and then keep going through them. Besides that, thank you so much. Thank you for being here. Thank you, Jason. Much appreciated. And
Thanks for having me.
happy Friday, everybody.
Yeah.
Please remember to hit like and subscribe if you are watching on YouTube, and leave us a comment. Let us know how we did. Let us know what you want to see on the next show. Thanks so much. We love you all. Have a good one. Thanks, Jason.
Bye.